So our next topic will be borrowing cost or borrowing costs covered by IAS 23. So the coverage of our topic will be core principles and scope, definitions, recognition, and disclosure. So let us begin first with the core principle and the scope of IAS 23 borrowing costs. So borrowing costs are directly attributable to the acquisition, construction, or that are directly attributable to the acquisition, construction, or production of a qualifying asset form part of the cost of the asset. Other borrowing costs are recognized as an expense. So this simply means that borrowing costs or basically interest relating to liabilities that were incurred in the acquisition, construction, or production of a qualifying asset can be or will be capitalized as part of the cost of that particular asset. If the said borrowing costs do not pertain to a qualifying asset, then it will be expensed. So the scope of the standard, which is IS 23, will be all borrowing costs. And the standard does not deal with the actual or imputed cost of equity, including preferred capital not classified as a liability. So this means that the only borrowing costs that we are trying to compute here are borrowing costs relating to liabilities. If these are costs relating to equity, it will not be considered as borrowing costs unless the equity has a substance of a liability. Okay, so what do we mean by that? So similar to this particular example, even if let's say for example we have preferred capital has a fixed dividend rate. If the preferred capital is in substance a liability, so meaning it can be a redeemable preference share, then we can still consider the borrowing or the percentage of the dividend as actually a borrowing. Because in effect, there is actually a maturity and therefore it is considered as a liability in substance. So just to emphasize, the basic concept here is that we are supposed to recognize only borrowing costs that are related to liabilities. Okay. So with that, let's proceed. An entity is not required to apply the standard to borrowing costs directly attributable to the acquisition, construction, or production of first, a qualifying asset measured at fair value, for example, a biological asset within the scope of IAS 41, or inventories that are manufactured or otherwise produced in large quantities on a repetitive basis. So first, qualifying asset measured at fair value. Why are we not going to consider borrowing cost? Because borrowing cost is only relevant if we are going to measure the asset at cost. If it is going to be measured at fair value, then even if you compute the borrowing cost and try to capitalize it, it's going to be useless and impractical because the fair value is the amount that we're going to recognize. Okay? And then for inventories that are manufactured or otherwise produced on or in large quantities on a repetitive basis, as specifically provided by the standard, we are not going to capitalize or account for the borrowing cost for that particular item. There. So with that, let's proceed with the definition. So what definitions are we going to focus on? First, borrowing costs. So borrowing costs are interests and other costs that an entity incurs in connection with the borrowing of funds or in connection with a liability. So in other words, these are interests. If there are other costs similar to interest, that's also considered as borrowing cost. That's why when we talk about borrowing cost, we are talking about the effective amount or the effective interest, not the nominal amount that we're just paying. So we are looking for the amount that is actually recognized as interest expense in this case. Okay. Next, a qualifying asset. Okay, next item in our definition, a qualifying asset pertains to an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. So when you talk about qualifying asset, the minimum is around 1 year. So for as long as it will take at least 1 year or one period before it can be finished, then it is considered to be a qualifying asset. So what are the items included as part of borrowing cost? First, interest expense as calculated using the effective interest method as described in IFRS 9. So basically, this is the um, interest expense that we are going to compute in the case of financial liabilities. I just emphasize that items B and C in the previous provision of the standard is already been deleted. So I honestly do not know what are the previous items there because I did not research on that any longer because anyway it's not going to be needed anymore. So just so we know that items B and C in the previous provision of the standard is now deleted. So what's left is A, D, and E. So letter D, interest in respect of lease liabilities recognized in accordance with IFRS 16. Because it is possible that we will incur or we are going to use the leased asset in relation to the construction of the property or in the construction of the qualifying asset. And since there is interest related to that, it is possible that we can capitalize it also. And then exchange differences arising from foreign currency borrowings to the extent that they are regarded as an adjustment to interest cost. So, if let's say for example, we are borrowing dollars in our construction and we are presenting it in pesos, any differences in the exchange rate or the amounts relating to when translated in pesos will also be recognized as part of borrowing cost. So to continue, depending on the circumstances, any of the following may be qualifying assets. It can be inventories, it can be manufacturing plants or PPE, power generation facilities. It can also be intangible assets, investment properties, and bearer plants. So meaning, any of these items can be considered as qualifying assets and therefore we can capitalize the the borrowings or the interests relating to that particular construction, purchase, or acquisition or whatever type of um, method by which we are preparing the asset. Okay? So these are examples of items wherein these are items that can be considered as qualifying assets for as long as they meet the definition of a qualifying asset. Again, to reiterate, since we are talking about qualifying asset, the standard did not actually provide us with a specific number of years to determine which is substantial. So, since the standard is principles based, it is up to the entity to justify that the construction or the preparation of the asset is actually considered as a substantial type. So, for as long as you can justify, you can do it. But of course, rule of thumb is that and even in problems that we encounter, most of the time there will be 1 year at least. Just the minimum. Okay, anyway, let's proceed. Um, Financial assets and inventories that are manufactured or otherwise produced over a short period of time are not qualifying assets. Assets that are ready for their intended use or sale when acquired are not qualifying assets also. Okay? So, the key thing here is that once you even if you are just purchasing the item, if the item is not yet ready for its intended use even after purchase, it will be subject to further processing or further construction or whatever. Then that's the time that we will determine if it is a qualifying asset. So say for example, you purchased a building. Even if the building was constructed 1 year prior to you using it, if you are not really the one who incurred the cost of the construction, then you cannot say that it is a qualifying asset. So it should be based on whether the item was ready when you acquired it or did you do further processing prior to using it. So that's basically the concept that needs to be satisfied here. So if the items are just being prepared over a short period of time, then they cannot be considered as qualifying assets. So with that, let's proceed with the recognition of your borrowing costs. So again, an entity shall capitalize borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset as part of the cost of the asset. An entity shall recognize other borrowing costs as an expense in the period in which it incurs them. So to emphasize further, is it possible that we are going to acquire, construct, or produce a particular item that is practically complete already, but it is not yet ready for its intended use? So these are some examples. So if I am an airline and I purchased an airplane, a brand new airplane, for purposes of operating it as an airplane for my airline's operation, then the airplane is not a qualifying asset because it is already prepared or ready for its intended use in my operations. But if let's say, for example, I purchased an airplane and I am going to convert it into a restaurant. So just a new concept. Instead of me building a building or building a restaurant, I'm going to use an old airplane, and I'm going to convert it into a restaurant. So in that case, the airplane is now considered as a qualifying asset because prior to it becoming an operational restaurant, it needs to be converted first. It needs to be further constructed. So in the same way, if let's say, for example, I will purchase a boat. So if the intention for me to purchase the boat is just to use it as a basic boat for transporting or whatever, then it will not be a qualifying asset because when you purchase the boat, it is automatically prepared and ready for its intended purpose. But again, if I am going to purchase a boat and convert it um a hotel concept. So I'm building a special type of hotel which is actually established inside a boat. Then the boat becomes a qualifying asset. So it's not a matter of whether it is operational. You need to determine what is the real purpose of why you acquired it. That's why the standard is very specific that a qualifying asset will only be such if you need to further process it on a longer period or in a substantial period of time. Okay? So that's how we analyze the concept. So, borrowing costs that are eligible for capitalization are as follows. Okay? So, the borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset are those borrowing costs that would have been avoided if the expenditure on the qualifying asset had not been made. Okay? When an entity borrows funds specifically for the purpose of obtaining a particular qualifying asset, the borrowing costs that directly relate to that qualifying asset can be readily identified. Okay? So, in the succeeding slides, we will actually determine there are actually criteria that needs to be made to be satisfied in order for us to start capitalizing the borrowing cost. But basically, the concept here is clear. The borrowing costs that can be capitalized are those that are related to the costs that would have been avoided if the qualifying asset had not been made or had not been modified or have not been constructed. Okay? So to the extent that an entity borrows funds specifically for the purpose of obtaining a qualifying asset, the entity shall determine the amount of borrowing cost eligible for capitalization as the actual borrowing costs incurred on that borrowing during the period less any investment income on the temporary investment of those borrowings. So this is pertaining to the specific borrowings. Okay? So in the case of specific borrowings, borrows funds specifically for the purpose of preparing the qualifying asset. So if it is a specific borrowing, what you need to do is to simply get the actual borrowing cost incurred and deduct any investment income from the unused funds. Okay? So that's very basic. If let's say, for example, the interest on the borrowings is 1 million, then that's the capitalizable borrowing cost. But if there is an investment income from the temporary investment of the unused fund. So let's say 1 million is the actual borrowing cost less, let's say 100,000 for investment income. Then the capitalizable borrowing cost is only 900,000. That's very basic. That's very simple. However, to the extent that an entity borrows funds generally and uses them for the purpose of obtaining qualifying asset, the entity shall determine the amount of borrowing cost eligible for capitalization by applying a capitalization rate to the expenditures on that asset. The capitalization rate shall be the weighted average of the borrowing costs applicable to the borrowings of the entity that are outstanding during the period. So this is actually very easy also. For general borrowings, what you need to do is determine two items. One is the weighted average costs incurred in the preparation of the qualifying asset, and number two is the capitalization rate, which is actually the weighted average borrowing costs. Okay? So what you're going to do is to determine all of the amount of actual interest. So example, you have borrowings 1, 2, and 3 with related interest rate of, let's say, 12%, 10%, and 9%. What you need to do is to compute for the overall interest. And then, once you get the total interest, you divide it by the total principal. That's the capitalization rate. So the capitalization rate will be multiplied to the weighted average costs incurred in the preparation of the qualifying asset. So usually this is done by determining the costs in January, or example for a given month. So if let's say, for example, if the cost was incurred January 1 of the current year, the weight is 12 over 12. If the cost was incurred in, let's say, for example, July 1 of the current year, then the weighted average or the weight is only 6 over 12 because it was incurred mid-year. Okay, so July, August, September, October, November, December. That's 6 months out of the 12 months. So what you need to do is to determine how many months, or how many, if you're using days, how many days it is outstanding over the entire year. And that's the weight of that particular cost. Okay, and then once you compute the weighted average cost, you multiply it by the capitalization rate, and that is the amount of borrowing cost that you're going to capitalize. However, we need to understand and we need to remember always that an entity shall exclude from this calculation borrowing costs applicable to borrowings made specifically for the purpose of obtaining a qualifying asset until substantially all the activities necessary to prepare that asset for its intended use or sale are complete. Okay, so meaning, if you have a general borrowing and a specific borrowing, you need to separate the total cost, okay, by getting first amounts that are related to the specific, and then the rest will be for the general borrowings. Okay? So if let's say, for example, the total cost that you incurred is 15 million, and you only borrowed 8 million specifically. So if that's 15 million minus 8 million, then it means that there is 7 million difference. The 7 million is now used for, or that was taken from the general borrowings. So for the specific portion of the borrowings, you simply use the basic formula, which is interest expense less any investment income. That's already the borrowing cost attributable to that. For the general borrowings, you multiply it by the capitalization rate, and that is the borrowing cost for the general portion. And then you add the two, and that's where you will get the total borrowing cost. Okay? So the amount of borrowing cost that an entity capitalizes during a period shall not exceed the amount of borrowing cost it incurred during the period. Okay? So at the end of the computation, you still need to compare the computed borrowing cost and the actual borrowing cost. Because if the computed borrowing cost is greater than the actual borrowing cost that was incurred, then what you're going to capitalize only is the lower of the two, which is in this case the actual. Okay? So you need to always do that. Do not forget that. Anyway, we have examples in our next videos in this presentation or in this playlist. Next, what if there is excess of carrying amount of the qualifying asset over the recoverable amount? Okay. So of course, the story is like this. When you are preparing the qualifying asset, you are basically accumulating costs. So you are accumulating costs for the materials, the labor, the overhead, and everything that is capitalizable, plus the borrowing cost, you're capitalizing everything. But at the end of the day, at the end of the construction process, you need to determine and you need to check the recoverable amount and the total cost or the carrying amount. And according to the standard, when the carrying amount or expected ultimate cost of the qualifying asset exceeds its recoverable amount or net realizable value, the carrying amount is written down, okay, or written off in accordance with the requirements of other standards. In certain circumstances, the amount of the write-down or write-off is written back in accordance with those other standards. So basically, it's like this. After the construction, you determined that the total cost, including the borrowing cost capitalized, was 18 million. But when you computed for the recoverable amount, it was only 16 million. So we cannot recognize the asset at 18 million because the recoverable amount is only 16 million. So the 2 million will be recognized as impairment loss at the time of initial recognition. So that's an automatic impairment loss. Okay? However, it is also possible that the impairment loss will be reversed. Like let's say for example, the item is a property, plant, and equipment. And the PPE, when you use the revaluation model, the 16 million had a new recoverable amount. Let's say for example, it became 20 million after a year or so. So in that case, you need to determine whether there is an amount for the reversal of the original 2 million that you recognize as impairment loss on initial recognition. So that's basically the concept there. Again, this will be emphasized when we discuss impairment and revaluation later on. To continue, commencement of capitalization. So when are we going to start the capitalization of the borrowing cost? Okay? So it says here, an entity shall begin capitalizing borrowing cost as part of the cost of a qualifying asset on the commencement date. The commencement date for capitalization is the date when the entity first meets all of the following conditions. So we need to make sure that all of the three are being satisfied. So in order for capital or for borrowing cost to be capitalized, number 1 or letter A, expenditures must be incurred. Borrowing cost must be incurred. That's letter B. And letter C, it undertakes activities that are necessary to prepare the asset for its intended use or sale. So meaning there are activities ongoing in preparing the asset. So all of these three items must be undergoing or must be in place prior to us recognizing the borrowing cost. Okay? But in this case, there will always be an issue. Okay? Because we can ultimately determine letter A and letter B automatic. But in letter C, it is possible that in the process of construction or in preparing the asset, there is what we call delays. Okay? Or there will be delays relating to our construction. So it says here, an entity shall suspend the capitalization of borrowing cost during extended periods in which it suspends active development of a qualifying asset. So that's why we are now going to emphasize temporary versus extended delays. When we say temporary, usually these are essential delays versus extended delays. So according to the standard, it is only during extended delays or extended periods of delays that we suspend the capitalization of borrowing cost. So in case the delay is a temporary or essential delay in the preparation of the asset, then the suspension is not going to be made. Okay? So example, in the construction of a concrete facility or a concrete infrastructure, there will always be a curing time for the cement to harden or for the cement to dry up. Because if you're going to continue the construction without the proper curing time for the cement, then the construction will ultimately fail. So therefore, the delay that it will take for the concrete or for the cement to dry up is considered to be an essential delay. Okay? And therefore, since it is an essential delay, then the capitalization of borrowing cost is still going to continue because the letter C is still being done. The activity or the waiting time is actually considered as a related activity in the preparation of the qualifying asset. Okay? However, if let's say for example, the reason for the delay is because people are not working anymore, they are on strike. Okay? They are not actually doing work in the facility. Then that is considered to be an extended delay because it is not related to the actual construction or actual preparation process. Okay, so in these cases, you need to determine whether the delay is temporary or the delay is extended. If it is only temporary, you do not suspend capitalization. You continue for as long as letter A and letter B in the previous slide, okay, are also present. Okay? Now, what if we are now going to cease the capitalization? When are we allowed, according to the standard, to cease the capitalization? So it says there, an entity shall cease capitalizing borrowing cost when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete. So when you say substantial, again, this is a principle. When do you say that the item is already substantially complete? Okay? So meaning, maybe for an item that is being constructed, what you simply need to do is to um, remove any items that are considered to be wastes or dirt on the facility. So then maybe it's already considered as substantially complete. So if what you need to do is only to clean the facility, okay, for final preparation, then maybe it's already substantially complete. But basically, you need to justify it. Anyway, in the board examination, the standard or the problem will give you whether the item was already complete during a particular period so that you can compute for the period by which borrowing costs will be computed. Okay? So with that, let's continue. When an entity completes the construction of a qualifying asset in parts, and each part is capable of being used while construction continues on other parts, the entity shall cease capitalizing borrowing cost when it completes substantially all the activities necessary to prepare that part for its intended use or sale. So meaning, the computation of the borrowing cost, okay, will be in portions. Okay? So if let's say for example, it is going to be 4 parts. So part 1 of 4, part 2 of 4, part 3 of 4, part 4 of 4. So once you are done with the computation or once you're done with the preparation of part 1 of the construction, you stop capitalizing borrowing cost there, and then you're only going to compute borrowing cost on the succeeding. Okay? Because it is possible, if you're not going to do that, that you're going to accumulate more cost by adding the cost of the previous part that was already completed actually, and it is already operational, and then in that case the base of your borrowing cost or the computation of the interest will be higher. So be mindful of always stopping the capitalization of a portion that is already operational or it's already prepared or substantially complete. Okay? So with that, we move on to the disclosure. So what are the disclosure requirements? So first, the amount of borrowing costs capitalized during the period with the necessary computations, and the capitalization rate used to determine the amount of borrowing costs eligible for capitalization. Of course, this is also with the computations related. So this is of course going to cover the specific borrowings and the general borrowings. For transitional provisions, particularly if you're going to use the standard for the first time, because this is the first time that you have a qualifying asset to prepare. So it says there, when application of the standard constitute a change in accounting policy, an entity shall apply the standard to borrowing costs relating to qualifying asset for which the commencement date for capitalization is on or after the effective date. But of course, this is not going to be our concern anymore because the standard was actually um, was actually in effect way before year 2000s pa. So meaning this is already in effect right now. So if you're going to apply the standard now, there will be no change in accounting policy because most probably the entity was using the provisions of the current IAS 23 even before the current period. However, an entity may designate any date before the effective date and apply the standard to borrowing costs relating to all qualifying assets for which the commencement date for capitalization is on or after that date. But this is not our concern anymore. Again, I simply place this just for our guidance. So the concept is maybe prior to using IAS 23, you are using a different approach in accounting for your borrowing cost. But basically, since this is the first time that you're going to use it, then you just apply the standard prospectively, currently and prospectively. So with that, that's the end of the presentation. The next parts of the playlist of these videos will have the problem solving and the other questions.